When we touched on it last week, we said that quite a lot of the benefit that materialised was down to the equity markets themselves, and that was doing a lot of the heavy lifting, if you will, and that's where the real benefit is driven from. I think when we look at the sort of longer term and how the markets have been behaving, we're sort of 9 years into a bull run. Yes, we've had a bit of a correction, and I guess that people are asking themselves how much longer can this market remain positive before maybe we have a proper bear market correction. A little bit longer.
How long do you think can this bull run continue?
Well, our opinion at Fern Wealth is very much that a correction like the one we saw at the end of January, the beginning of February, is good to just recalibrate expectations from market investors, give those who are a little bit nervous the opportunity to get out, recalibrate the PE ratios of equities out there as well as share prices drift down. And I think, quite frankly, from a psychological point of view, humans, when it comes to trading, just don't like to see a straight line for too long. And a bit of a correction, I think, in the longer term is actually going to be a benefit to the bull market.
Absolutely. Now, let's take a look at the broader interest rate environment now with the Swiss National Bank keeping interest rates, especially the deposit rates, at minus 2.5%. How is this impacting the pension funds who so much depend on the interest rate environment?
I'm afraid to say when it comes to the likelihood of the Swiss raising rates, there's still quite a few hurdles that need to be cleared before we get that. I think when you touched on it earlier in regards to the Swiss franc euro or the euro Swiss franc, the Swiss National Bank chairman, Thomas Jordan, has already stated on numerous occasions he feels that the Swiss franc is overvalued and they'd like to see that recalibrated. And as much as we flirted with 120, I think we'd like to see that rate move back up there. And I think while that's still the case, it's unlikely that the Swiss National Bank will do anything as far as interest rate rises are concerned until after the European Central Bank. And as far as the European Central Bank are concerned, they've already stated they'd like to bring quantitative easing to an end first before they then move on to interest rate rise policies themselves.
You've briefly mentioned currency, and since the removal of the peg of the Swiss franc to the euro currency in 2015, many pension funds have actually suffered losses. How do you see the currency exchange risk for them at this point in time?
Well, interestingly enough, we've heard stories over the last couple of months about numerous businesses having to move operations out of Switzerland. And when we spoke last week, it was Nestlé's turn, moving 500 jobs over to Spain, rather, on their, I think it was their Nespresso range. Nonetheless, moving jobs out. And when Switzerland's largest market capitalized company continues to move jobs out and is publicly stating the reason they're doing it is because of the strength of the currency, I think you'll start to see politicians taking note, not just central bankers. And that may well be a bit more of a tipping point to put a bit more pressure on the Swiss National Bank to, rather than just talk about it, actually move into action, as it were.
But we have so much foreign exchange risk in the market, so much volatility at this point. So what kind of hedging strategy to protect themselves should pension funds take?
Well, certainly a large percentage of our clients, in fairness, are actually expats rather than Swiss nationals, although we have both. So we proactively encourage our clients to look at their overall currency risk exposure and where they're ultimately going to be when it comes to their retirement, not necessarily Switzerland in many cases. So we do look at proactively trying to hedge against that risk. As far as pension funds are concerned here, I think that it's been the euro side of the equation, as far as the euro Swiss franc, that's done most of the move we've seen in the last, say, 18 months from about 106 is up to this current 116 level. We do want to see maybe the central bank start to do something themselves rather than just talking about it.
Absolutely. Action speaks louder than words. Now, in which asset classes and countries do you think that the pension funds in Switzerland should invest? Because their strategy is mainly long-term and safe haven bets as well.
When we look at the Swiss pension system, the Pillar 2s and the Pillar 3s, it's what we would refer to as the bottom rung of the investment ladder, and rightly so. It's a pension fund. So the risk categorization should be low. By definition, it does mean that the equity exposure of funds and investment vehicles that pension providers will be allowing you to have is a maximum, say, 50%. Switzerland's slightly unique in regards to allowing its pension pots to have more property invested in there. And I revert back to the Swiss National Bank again, who stated at the beginning of the year, the turn of the year, that they felt the housing market here in Switzerland was reaching a tipping point, and they were cautious. They were putting cautionary notes out about it. So that is one area of divergence that the Swiss pensions allow. I think the fact that it's been the driving force in equity markets, really, I guess, has been the tech sector. And we just need to look at, say, NASDAQ to see how that's been the real driver over in US equity markets.
And we've just seen that over the last couple of hours. Now, it is, though, a focus for the pension funds, not just in Switzerland, but around the world, to really not invest too much into equities because the markets are so volatile, but more into fixed income and debt instruments, isn't it? So where should the Swiss pension funds go and look for those?
I think when it comes to the pension funds, more broadly, not just Swiss ones, but globally, they've had a lot of battles on their hands. Obviously, demographics with a larger percentage of the population being old and less working population, and that doesn't help the balance of pressures. But I think we have maybe seen with the yield rates on US debt actually tipping that 3% level, we're just maybe beginning to see a little bit of light at the end of the tunnel as far as pension funds are concerned, and the debt market beginning to, whether it's sovereign debt or corporate debt, just beginning to help do some of the heavy lifting that the equity proportion of their portfolios have been doing so far.
You mentioned the risks and challenges, aging society, changing demographics. Which are some of the other key concerns that you have for the pension funds in the next couple of months?
Well, I suppose it's income is a key part of what pensions require because they need to pay out money on an ongoing basis. So dividend yields and equities play a large part in what they're looking at. So strong companies with strong balance sheets, the ability to pay out dividends to their investors, the pension funds as well, is obviously a key driver in where pension funds will look to invest their money.
Absolutely. Now, before we go, let's talk about Swiss Re as well. We heard that it announced the launch of an offering of some $500 million, 6-year exchange note. What does that mean for Swiss Re? I mean, it is probably just renewing its note, or is it in need of raising more cash at this point, do you think?
It's an ongoing debt refinancing is an ongoing process that periodically needs to be done.
It just reached the end of a cycle, I imagine.
It's an ongoing system whereby it'll effectively be overlapping itself over periods rather than all of it coming to an end at any one point in time. And this is a key aspect of all corporations, I think, not just Swiss Re.
So how well positioned is Swiss Re going into the next quarter, do you think?
I think much like many Swiss companies, they'd like to see an improvement as far as the currency is concerned. And that's certainly something I've read on a couple of occasions as far as Swiss Re is concerned. A rebalancing of where the Swiss franc is and a cooling of its power will actually help them.
Thank you so much. That was Alastair McCaig. He's director at Fern Wealth.